trust your ability to understand. So therefore, so what we thought of doing today is, discuss some of the questions covering the areas what we discussed before. That is the company accounts, VAT and etc. etc. Because you need to have some hands-on experience and working out something. Because ultimately, at the end of the day, whether it be VAT or VAT on financial services or normal the income tax liability, you should be in a position to compute. What I've seen is in practice, even in the examination, the students know theory, but they do not know how to compute the tax liability, right? So therefore, for your examination as well as the practical perspective, it's important that you have some hands-on experience. So therefore, in that particular context, we will discuss some examples today, so that you all will be familiar with how to apply what is being discussed before. So therefore, the first priority for today's session is on discussing the questions on the areas what we discuss. And so thereafter, from next week onwards, we'll be having physical lectures where we will discuss, especially the from international taxation to tax planning. Probably might be able to complete the international taxation next week itself, together with a couple of examples. Because international tax is also important, especially in the today's context where the government is inviting many foreign investors to come and start their businesses here in Sri Lanka. So therefore, so we should facilitate them. A lot of exemptions, etc., have been given, and they come and start the businesses here. And Sri Lankans are going and start businesses in various other countries. So therefore, the things like double tax treaties, right? And the international taxation is very important. In the local and global context both. So therefore, we will discuss the international context taxation in respect of individual as well as the companies together double tax treaties next week, and then we'll move on to discuss other important areas like especially the tax planning and tax administration, right? So then today we will start first we'll start these questions, right? And then we'll move on. Kokila, this document okay, so we'll start with the income tax questions, no?
Yes, sir.
Okay, so then you start, so we'll.
Document also shared in the group. We'll start income tax. Basically, this is income tax to understand basically latest changes, because a lot of students came across with the different tax rates we are used for the first 9 months and the second last 3 months. So that this is also you are these days you may practically facing this difficulties how to recognize or how to calculate that payable. Income tax payable on 9 month and 3 month by applying the different rates, because that 9 month the standard rate is 28%, then the 3 month is they have reduced to 24%. Then again we have the predominant rule is mainly for applicable 9 month, then no more predominant rule applicable with effective from 1st January 2020 onward. Then the whatever the income, even if it is 10% or 20%, then they can with the concession rate 14%. If it is
Sorry. Kokila, what Kokila said is very important, for you all, because especially during this year 2019-20 year of assessment, the profit will be subject to tax at 2 rates. The first 9 months will be applicable, will be taxed at 1 rate, whereas the last 3 months the profit will be subject to tax at a different rate. So therefore, it's important, especially identify how to segregate the total income in between the two periods, and then determine your tax liability. Second one, what he said, this predominant rule is another important rule where that particular rule is, you all know what the predominant rule, because we explained y'all in detail I think second or third session, and that once again will be applicable only till 31st December 2019. So thereafter the particular rule is not applicable, right? So therefore, those important salient features will have to be remembered. We never know whether probably government might take out some of these concessions given from the the next budget. But again, still, so these rates and the concessions are applicable, especially for 1920, and might be even applicable for 2020-21. Probably whatever the new rates that are going to be introduced might be applicable from 2021 or 2022. Anyway, we'll wait and see for them. But again, so we'll now work out based on the I mean the concession given by the government in the last year.
Yes.
Yeah, Kokila, continue.
Then we'll move to the requirement first. They says compute the compute income tax payable by ABC company for the year of assessment. Then as Sanjay also explained, the year of assessment 1920. Then you know that this we have to segregate 9 month and 3 month separately and work it out after calculating the taxable income. So I will move one by one. It is ABC company. Here again, key point is manufacturing company. It says manufacturing rubber product and to local market also they are supplying, and also the foreign market. They have two components: the export part and also local part. They are manufacturing company. Then as per the new regulation, new proposal, manufacturing company, we aware that last 3 months the applicable rate is 18%. Then again, if it is export, they are providing to export, then the last 3 months we can have it 14%. So then, we need to be mindful when reading this question. Then in order to separate two period and apply the relevant rate. So if I will explain the latter part also detail as per the financial statement prepared for the year ended 31st March 2020 as follows. Company submitted estimate and statement of estimated tax payable. This is, we call it as set. Normally in the beginning of the year, normally what you have to do is you have to estimate entire year how much would be the tax liability for this year. Then normally what companies do is, then they take the previous year tax liability. They might think based on the current market trend, they might increase some percentage, or they might reduce some percentage based on even the COVID situation. The next year they can forecast with less amount. So likewise, they have to forecast their taxable tax liability, tax payable. Then they have to file estimate income tax payable from the beginning of the year. Then this company also, they have filed estimate income tax payable 15 August 2019. Then this is also the same. If you can listen, all the companies 15 August 2020, they filed it for the year of assessment 2021. 2021 year start from April 1st 2020. Then the April to June quarter, August 15 was the due date for first installment of income tax. Then at that same time, they are required to submit set form together with the payment to the Inland Revenue Department. The same thing, the year of assessment 1920 also, they have done the compliance, the set filing and the set filing for the quarter, beginning of the quarter. Then if it is there any subsequent changes in the forecasted amount, then later they need to change it. Then they have to submit the revised set. They have to submit the revised set. If it is, then they estimated the income tax payable from the beginning of the year 50 million. Let's say if it is estimated is wrong, then second year they realize that no, that is not the correct one. It should be 60 million, or else it should be 40 million. Then they have to amend and revise set also required to be filed. Then the second quarter. So likewise, they in this company ABC, they have filed the set form, which it was due on 15 August 2019. Then they have turnover. They have provided turnover detail based on the financial statement. They have local sales and also they have foreign sale export. Then it says that the payment received in foreign currency through a bank. Then the important points I am highlighting: cost of sale, they are deducting cost of sale, then the profit, gross profit, then other deductions they have deducted, and other income. Also they have interest, dividend, and also foreign consultancy fees also they have. Right? Then the profit they have recognized in the P&L is this much. Then the information also provided in this calculation, ESC they have paid, because you know the ESC we had only for 3 quarters in the year of assessment 1920, April, from April to December. We have only 3 quarter ESC. If there is any brought forward, if it is not especially given, then we can take whatever the given ESC figures as ESC paid for recent 3 quarters, last 3 quarters at the 9-month period. There's a question: if we did not submit any amendment set IRD, the take originally is applicable for whole year. Yes, the one student is asking question, the important question. It says did not submit any amended set. Does IRD take original set as applicable for whole year? Exactly. The IRD will take the whatever the set form you have submitted previously for is applicable for whole year, but then the same liability you have to pay throughout the year as you initially submit. If you see this screen, I will share the from the beginning, even the by taking the our current year of assessment. Let me explain the rate changes first. I will explain rate changes first. This is for 9 months, basically 9 months. This is 3 months. And period. So 9 months is started from April 2019 to 31st March 2020. This is the 9 month will end up with December 31st 2019. Then this is the period basically. During this period, what you have to understand is basically there are several rates in the year of assessment 1920. In your year of assessment, very important, because you are dealing with the year of assessment 2019 and 20. So this period, as you are aware, we have basically we have 3 different rates. The first one is concessionary rate, it is 14%. Then you have standard rate. Standard rate is basically what is 28%. Then the higher rate 40%. It is for mainly liquor and tobacco. So we had only these 3 rates. This 14% is subject to predominant rule. If it is more than, that means the predominant rule is the turnover. If it is more than 80% of the gross, so the predominant rule, if it is satisfied only, they can enjoy 14%. So the balance 3 month onward, basically first of January onward, with the recent government, they change it. They change it to the rate. Basically, they introduce. Normally, we had concessionary rate. It is 14%. 14%. No more predominant rule applicable. And then the standard rate is now they have reduced 28 from 28 to 24%. Then the higher rate remain as it is. These are the rate changes basically they introduced, and also one more new rate is for manufacturing businesses. Manufacturing rate, it is 18%. This the reason. Another introduction of new rate. Now we have four tax rates basically: 14%, 18%, 24%, and the 40%. These are the rates applicable for your year profession. And also the question, I will move to the question you asked. Then the year of assessment, year of assessment 2019-20. Then what was required from you is every taxpayers, we can divide this year of assessment into 4 quarters basically. Then initially from the starting of the year, each company are required to submit set form when they are estimating their tax payable. The Q1 basically, previous law you had basically you can go with prior year basis. Under new law with effective from 2018 19 onward, there is no any provision for the prior year basis. What you can do is you have to estimate the tax payable. Then most of the company they are doing, they will take the prior year one and they will change few percentage and the increase or decrease based on the market. Then they are required to file the set and pay the liability based on that. What is the requirement was, let's the tax payable, if it is tax payable, if they assume income tax payable is estimated, if they estimated income tax payable for this year, let's say 100 million, then what they are doing is they have to divide for this 100 million and pay this 25 million to IRD. The date was of 15 August 2019, like they did. Then the same time, this 25 million together with 25 million set form also required to submit estimate of estimated income tax payable. Set also the due same date by declaring 100 million as a tax income tax liability and the payment also. Set also they are required to file. Then the second quarter, or else let's say third quarter, you realize that tax payable should be you realize and calculate a tax payable as 120. Then what is the requirement is, then you have to anyway revise the set what you have initially submitted. Then the scenario is mainly important for you is I change this tax payable to 80. You realize that due to COVID situation or the this year anyway you passed, let's say you realize this period 80 should be the liability. Then what you are doing is, then you realize that 80 should be the liability, you are going to pay 80 for the balance period. Then you paid in the second quarter also, let's say 25 you paid, this quarter also, second quarter. Then the third quarter what you are going to is payable is 80. Then you deduct, what you can do is you deduct 50 million you paid, then the balance 30 you will do 30 million by dividing two quarters 15 million you are doing currently. based on the question you raise. Then you pay in 15 million for this quarter, and this quarter also the same, right? Then department is, they are not aware. In the revenue department, they are not aware about this arrangement because you have not submitted a set form for this quarter because of the revision. Due to this revision, you may reduce the payable, but you aware, but department is not aware. They are not aware. Then what they will do is they will take the same 25 million which is due from you, then the balance 10 million they will impose penalty. This is subject to because they will take the whatever the initial set. What you would have done is you have to submit if it is change is going in the third quarter. They would have done the revised set. Then we call it as revised set by declaring 15 million is recommended method. Then since they have not submitted the revised set, then there is a penalty exposure. Then you have to take action immediately to revise the set and do the necessary to avoid the penal provisions. Hope you understood. There is still any other questions? Is it clear to you? Is it clear? Yeah. Yes, Tirani, you can ask. Hope it's clarified. Then I'll move to the question again. Then you are aware about these things and the income tax paid. Also, the other information they have provided, income tax paid is 38 million. And the note is there, the no expenditure incurred on interest and dividend, because they have given this one. And the same time, if you can think about the interest and dividend, those are passive income. Definitely they might not incur any expenses relating to this unless if it is a finance company or an investing company. If it is so, then they might have expenses on such income. Other than that, dividend and interest, there may not be any expenses relating to that. If it is especially given, then you need to check whether it is allowable. Then if so, you can allow it. If it is not, you have to disallow. So then that turnover based on this rate changes recent amendment, they have given the turnover split by separated into two periods. The first period is basically 9-month period. The 9-month period, and this is 9 months. This is also this is 3 months, the second period. So they have given the two periods separately. And then the local market, the foreign market, then the local market, normal local sales, the foreign market they export, and the dividend income they have, and additionally they provided donation to approved charity. Then withholding tax on dividend, withholding tax deducted on interest 20. Then the withholding tax deducted on dividend is 420, right? Then withholding tax also given, withholding tax deducted on interest and dividend. So we'll calculate the income tax payable income tax payable for this company for the year of assessment 1920. So we'll move to the calculation. Yeah, I'm sharing the screen, Excel format. Hope you can see the screen. Yeah, I hope you can see the screen. See, this is computation of income tax payable. What we can do is basically what we are going to do is the first of all we need to prepare plus minus, basically plus minus in 1000, the computation of income tax payable, the period profit we need to take it here. Basically we will do the profit as per the fiction given. This is the profit. This may be the profit. What we are going to do is whatever the income included in the profit which are exempt or the final withholding tax payment, we have to separately remove those things. Then what we will do is basically then since there is a foreign consultancy fee, basically the recent changes, due to recent changes there is a foreign, if there is any foreign service rendered outside Sri Lanka, then payment received through a foreign currency, then you can take that exemption also. Then I will move to the recent changes which we have already shared with you. This is the recent changes came with effective from 1st January 2020 because of the recent exemption they introduced to the new Inland Revenue Act. These are the recent exemption they have granted for the all taxpayers. Then moving to this next page. Here, any service rendered in or outside Sri Lanka. Any service rendered in or outside Sri Lanka to any person utilize outside Sri Lanka. Then to be utilized outside Sri Lanka. Then you are providing consultancy outside. Then to be utilized outside Sri Lanka. Then the payment of such service received in foreign currency through a bank. Then if it is received through a foreign currency through a bank, then you can enjoy the exemption. Therefore, this is applicable for, keep in mind, with effective from 1st January 2020. Then if it is not so expressly mentioned, here this one, you can see and here the gain and profit earned or derived by any person. Here there is exemption, agro farming. Then exemption is applicable from 1st April 2019 onward. They have make the amendment with backdate effect from the year of assessment 19 to the beginning of the year. Then if it is agro farming company, then they are exempt from the beginning, even 9 months also not liable. So here the case, the not expressly mention any effective date. In that case, it is applicable with effective from 1st January 2020. Here the exemption is, we know that, then the 1st January 2020 onward it is exempt. Then we are moving to the calculation. Here the calculation is, we can see what we do is they had consultancy fees 10 million. Then we have to remove that 10 million by identify that 10 million is here under other operating income. This is 10 million. Then are we going to exclude entire 10 million? No, we are going to remove 1/4 of that 10 million. 1/4. Then 1/4 of that 10 million is basically 2.5 million. It is for the exemption period, the 3-month period. Basically, this is for 3-month period because exemption is applicable with effective from January. And then whatever the income, other income which are exempt, or else if it is not related to business income, then we have to remove. Then we know that there is a dividend under other operating income, dividend received from a foreign company. Then the dividend, they have 4 million. Then also they mentioned that split of the dividend here. Split of the dividend here. Then second period they have received dividend 1 million. First period dividend is 3 million. Then we know that the first period definitely is applicable for withholding tax 14%. Then we treat it as final withholding tax. Then what we are going to do is, if it is final, then this withholding tax is final first period. Then we will remove. It is saying that final withholding tax payment. It is here. It is final withholding tax. XM amount we adjusted. It is dividend also final. Then we adjusted. Then in investment income also we have to remove from here, investment income. Then what are the investment income we have to remove? Then again we have to remove investment income. Let's add one line for interest, and also dividend. Then interest, we'll see how much they have under other income. They have interest here 1 million. Then we are removing that one. And also the dividend we have to remove as an investment for the balance 1,000. Here the balance. And this 1 million also we need to remove. That previous 3,000 dividend we remove separately because of withholding tax, final withholding tax. This dividend we are removing by concern that because this is not the business. We are calculating here business income. Then therefore we are removing all the investment income, and we will add separately when we are computing the investment income, because this is investment. Here also this is investment. This is we remove basically exempt, right? Then what we'll do is, then we'll move to the exemption. They have whatever the expenses. Then we'll move to the calculation, and we took interest and we took dividend also, did the adjustment, and also foreign consultancy fee also we take part of that 3-month period by proportionately. So then we took all the income which are not related to business. We removed all the part. Then we'll move to the expenses. Basically, they have given in the other information. Under other information, these are the other information they have provided. Then under this, we can see there's a donation. Anyway, in the donation, there's 600,000. So even if it is 3 months or 9 months, we don't worry. Entire 600,000 donation, what we have to do is we have to add it back. because even though if it is approved charity or any other, then what we have to do is we have to add it back any donation. So then, so we'll do the adjustment donations. Here we will add the any other donation on the basis that those are not incurred in the production of income. Expenses which are not incurred in the production of income. That basis, if you see anywhere in the information given, when you are doing the plus minus of business income or the investment event, then the donations are not allowed. Then you have to remove donation entirely when you are calculating plus minus and when you are arriving the accessible income from business. Then the later you can treat which donations are, then whether it is approved charity or the government, then you can make necessary adjustment later under qualifying payment. So then, first of all, you identify the donation and added back that donation because they have deducted from the business profit. So then we added back. Then again, special adjustment is expenses which are relating to exempt amount because we identified exemptions 2.5 million. This is as an exempt. Then we need to remove the expenses attributable to this exempt amount. We have to disallow because they have foreign consultancy fees. Then it is exempt for last 3 months. Then attributable to that part, expenses which are attributable to that part, then what we have to do is we have to remove, disallow. Then all expenses I will take here, all expenses, all expenses, I am taking from here. These are the all expenses they have given here. Then the all expenses they have 216, 200 million, 200.6. Then what we disallow exactly is basically we remove donation we remove. Then the balance part, balance 200,000, the balance expenses. Then we need to identify expenses which are attributable to exempt amounts because it especially says that if there are any donation, Inner Act says if there are any exempt amount, any expenses relating to that exempt amount, you need to identify it and disallow. Then we are going to do that. Then they have entire 200 million expenses. What we will do is, then we will do the expenses amount, then how much they have income. They have income, total income. I will take it here. Total income is basically 1.1 million, 1.1 billion basically. So these are the turnover, and also it says the exempt amount also, exempt amounts is 10 million. Then altogether 1.1 billion. So they have total income this much. Then what we have to do is income related to exempt amount. Basically exempt amount is, we know that exempt amount for the period we are going to disallow is 2.5. Then what we are going to identify is we are going to disallow expenses dividing by total income and multiplied by XM amount. Then 450 million. 450 million are required to disallow as a disallowable amount which are relating to XM income. So is it clear to you how we disallowed this XM expenditure which are relating to XM amount? Because final withholding tax payment, I will remove this part because we don't, the examiner given, there is no any expenses relating to final withholding tax. That means dividend. Then only we have expenditure relating to XM amount. We remove that part. Is it clear to everyone? Then we are ending up with accessible income from business, because we took all the adjustment, this donation also we considered, which is charged to the PNL. Then they have not especially given any other adjustment like we do normally, any other adjustment. So because this calculation we are mainly focusing how to apply the different rate for these two periods. That's why the mainly by applying few only adjustment, mainly donation and the expenses attributable to XM amount. So then moving to the accessible income from business, we are find that we arrived accessible income from business 307 million. Then we are going to calculate investment income, accessible income from investment. Then what we are going to do is investment, we remove the investment from here, business plus minus. What we are going to do is we will add into the, we are removing here and adding to the investment plus minus, investment income plus minus. We even dividend also we added, because final withholding tax on dividend, this is we are not going to add to the investment because it is anyway final, no need to add. If you are going to add as a dividend, then you lay from the bottom again you have to remove saying the final withholding tax on dividend. Then if you wish, you can add here and show it as a total investment, and later what you have to do is you are going to add all the dividend here, the 3,000 and the 1,000. Then again you need to deduct less, in less dividend subject to final withholding tax. Again you have to identify the withholding tax deducted period is basically the 3-month period, this period. Then again you will end up with the balance 2,000. Then the accessible income from investment would be the net of these two, the 2,000, 2 million basically, right? 2,000 here will say in 1,000, 2,000, right? Then what you are going to do is you calculate business income and also the investment income. Then you need to total it together, you will end up with accessible income. Then you know that this is accessible income, right? Then after arriving the accessible income, what you are going to do? Then under section 52, what you are going to do is under section 52, you need to deduct whatever the qualifying payment, right? Under qualifying payment, we aware that there is a donation. The donation, there we identified they have made that donation to approved charity. Then the first 9 months also they have segregated, 3 months also they have segregated. Then 9 months and 3 months, they have given separately the donation. Is it a matter to us the donation is given 3 months and 9 months? Then it is, we are anyway not considering that it is 3 months and 9 months. What we will do is entire donation we will consider, because there is no any changes to the law, right? Then what we will do is altogether 600 they have donation. Then what we will do is we will take that donation to the approved charity 600. Then whatever the disallowable part, you can take it here also, the donation entirely. Then because you can't take it exactly whatever that you did in the plus minus, because you need to identify whether it is approved charity. Then approved charity anyway the same in this example, then the 600 entire. Then what you have to do is 1/5 of the taxable income. Very important point. Okay. Then the 1/5 of the taxable income, can we do the 1/5 of the taxable income here? Because we know that taxable income here. Taxable income here, this is kind of iterative in the Excel. Please call it as, because can you do this one? Because taxable income, this one, then you need to take 1/5 of the taxable income. Anyone, because I explained this one in when we are doing the theory part in the second session. The donation, what we can do is in order to overcome this situation. Can anyone tell me?
So we can get the taxable income before deducting this particular donation and get the 1/5 and compare with 500,000 and go with the highest one.
Yeah, that means from the taxable income without deducting this one, right? Yeah, that is also can be done with the iterative. That alternative remedy is basically what we did was the 1/6 of the assessable income. If you can take 1/6 of the assessable income equal to 1/5 of the taxable income. Then I will show you soon after we finish this one. Then the limit is exactly, you correct. The same method we can do the same with this. This is 500,000 is as per the section 52. Then they have the big amount because they have assessable income amount. Then 1/6 of the assessable income. Then what we will do is then we need to take whichever is lower. Whichever is lower. Then we'll put minimum, this one or this one. Definitely we know that this is minimum. Then we are deducting this. We will end up with the taxable income, this one. Then the same is we can do is here the 1/5, this one will not take because of the amount, it is higher than that. I will explain the situation where, let's say, normally what in the calculation we did when we are doing the theory part is basically, let's assume that in your case, let's say 120 is the assessable income. Assessable income, I will explain the same here also. Assessable income, let's say you have qualifying payment is 20, then you will end up with taxable income 100. Taxable income. Then taxable income, then the law says 1/5 of the taxable income. Then 1/5 of the taxable income would qualify for qualifying payment. 1/5. So then without knowing this, we don't know exactly 1/5 of the taxable income. What we will do is we are taking 1/6 of the assessable income. If we are taking 1/6, then it is also equal. Then if we consider 1/5, also the same. 1/5 also the same. 1/6 also the same. Then if I am not taking here the minimum amount, then would become here also. If I am not taking the this 500,000 as a minimum, because we took 1/6 here, then 1/6 entirely we deducted from here, and then this we write this one. Then here what we can do is we can check 1/5 is also the same. Here this one is also the same here. Then it is clear that the both are same. The 1/6 of the assessable income in the exam point of view, it is easy for you, because if there are any other qualifying payment, then you will end up with big issue. Then when you are calculating, then what you have to do is, when you are calculating, you have to word in the calculation, you have to word it properly, 1/5 of the taxable income. But in the mind, you have to say that 1/6 of the assessable income. In the mind, you have to calculate like this. Then you need to write it down, 1/5 of the taxable income, but your mind should work 1/5 of the 1/6 of the taxable income. Right. Then the minimum criteria will put here. Then minimum amount will take here. Then the 500,000 as per the law. Then even if it is 1/6 is given higher amount, we need to go with lower amount, because in order to reduce there may be some cases where, in order to overcome the situation, to reduce their tax liability, they might pay more donation. By agreeing with the other party, we will do the donation to approved charity. Then they can gain financial arrangement. So then, to reduce that, overcome that situation, they have restricted maximum up to 500,000. Then they will end up with taxable income 309,450. Then the gain important point. Then we arrive finally taxable income. What we have to do is, this taxable income, we need to separate it into 2 periods. You need to separate it separately, 2 periods, 9 months and 3 months. Basically, first period we call it as 9 months. I will make it is 9 months for your easy reference. 9 months, and this is 3 months. 3 months and 9 months. So then you are aware that this is the breakup. We are going to divide whatever the entire taxable income by dividing here into 3 months, 9 months and 3 months, entire taxable income. So what we are going to do is, then the dividend income, we clearly require to identify. What we have to do is, dividend income here, I will take one by one. Dividend income, if there is a dividend income, we will take dividend income. First 3 months, we know that, because we exclude that part as a final withholding tax. Then the second part only, there is a dividend income. then it is basically 1000. The dividend for the 3-month period. The dividend amount is 1000. Then the interest income, we need to identify how much they have interest income again, because dividend we take this net 3000 and 4000, this net is 1000 we taken here, and interest because by removing the final, then the interest we have, then the altogether investment part 2000. Then finally we can end up with the business income 307. 307 is the business income. Then we know that all three is clear. And then these three, the total is tally with the taxable income. Then you can match the taxable income. These two, there is no any difference. You identified each sources separately. Then what you can do is dividend first 3 months, no dividend is applicable because it was final. Then you remove that part. What you can take is 1000, you can take it here. Because 3 months, anyway, there is no withholding provision because they removed withholding tax from withholding section, because now it is liable in the hand of recipient. Recipient is liable to pay withholding tax on the withholding amount they receive. Then here I will show you the exemption in the PDF, the recent amendment they announced. I will show you how the dividend is liable 14% is here. Dividend received from a resident company, it is subject to 14%. Then the dividend, it is 14%. So then in the hand of recipient, then they are required to pay dividend tax on the dividend received with effective from 1st January 2020. Keep in mind, because previously there were no any withholding tax because it was final, because withholding tax deducted. Then the interest income based on the guideline they have provided, we have to take pro rata basis. Then the 9-month period, by dividing 12 into 9, we take it here. For 9 months 750, then the balance 3 months 250, altogether 1000. Then again you have to take business income also under pro rata basis, divided by 4 multiplied by 3, and here the divided by, then altogether again you will end up with the same amount. Right. Then there is a qualifying payment. Different is we now is for basically qualifying payment, right? Then the qualifying payment is, we are aware that it is basically they are given for the business. We are not going to deduct this qualifying for payment for investment or the dividend. Then that one also we need to separately adjust it here. Right. Then the difference is 309 business income. I am going to take this business income and remove I will do the adjustment here, the 3 month and 9 months separately. The qualifying payment also I am going to apportion by removing these two. I will take total income, taxable income here. I will remove from here this investment and dividend. Then the balance, I am going to segregate it to two. 1/4 and 1/3. Right? It is now 0 because I took this total income as a taxable income because I need to adjust qualifying payment here. Because if you took the business income from here, then the qualifying payment adjustment will not come. Therefore, what we have to do is taxable income we need to take here. Then whatever the investment you can remove, and the balance we can divide it as a business. Then the final part of the calculation. The final part of the calculation also very important because of the rate. That is the main target in order to understand. You to understand the different rates, how you are going to apply. Then first of all, the easy part, soon after you separated the taxable income into relevant sources, then you know that dividend income definitely it is subject to 14%, right? Then the interest first, then the interest income, what you can do is interest income, the I will make it this rate also with months. Then the dividend first month is anyway final. Then the second month 14%. Interest first month 28%. Then the next 3 months is second period is 24%. Then the other business income, then there is a case how you are going to separate. Then the first 9 months and last 3 months. The first 9 months you need to see this 9-month business income, which is mainly they comprise basically, if we go to the calculation they are given, detail they are provided, then here you can see they have income sources first period, local market as well as foreign market. Then they have local sale and export. They have local sale and export. Taking into these two into the consideration, this is altogether 600,000. So 600,000, then what we can do is we need to check how much is the percentage. Then if we consider this one, let's see whether these two is 600, and what we can do is the export they have 100 in 100, then the 17% first 9-month period they have export 17%. Then export we aware that 17%. Then what we can do is that export, it is not in, even if it is 9-month period, not compliant under predominant rule, because it is turnover, it is below 80, then we can conclude that it is anyway below 80% rule, 80% predominant rule. Then this period income definitely it is subject to 28%, the higher standard rate. Then this period 28, we can conclude that even if it is, if there is export, then 28, because not comply with the predominant rule, not satisfy the predominant rule. So then the 3-month period, what they can do is based on the recent proposal concession granted to the taxpayers, what they can do is they have 2 different tax rates. They have because from the beginning I explained they are doing the manufacturing part as well as they are providing export. Then this 76,000 1,000. Then we need to separate it to manufacturing part, as well as they need to separate it, this amount, export, basically export. Now what is they have made outside Sri Lanka, whatever the supplies they made outside Sri Lanka. So then export and they have manufactured. What they can do is they need to identify, then the manufacturing percentage, we can apply 18%. Then if it is export, then we need to apply 14. Then how you are going to apply this 18% and 14%? How we are going to apply? Then what we can do? Can anyone comment on that? How we are going to apply 18% and 14% for this 76? Right. What we are going to do is basically we need to take turnover basis for the apportionment. That is why they have given the turnover for first 9 months and the 3 months. This is 9 months and also the 3 months they have given turnover breakup. Then what we can do is we need to apportion the turnover and percentage. We need to work it out and see the taxable income, see the taxable income by apportioning this manufacturing and export part based on the turnover. So what we will do is we'll take the manufacturing, they have 76 million. Then we'll take the total turnover from this calculation. They have total turnover for 3 month period 500,000 they have. Then we are considering these three. I will take different. Then this is basically we are doing the apportionment for the manufacturing part. That they have taxable income 76,863. Then what we can do is divided by total turnover and multiplied by whatever the local part. Local part is 300. It is 446,180. So then the export part also will do this one divided by 500,000 and multiplied by foreign portion is 200. Then we'll do the calculation and it is 30,745. Then we are going to calculate whatever the income based on the applicable taxable income what we have separated into two periods. So basically we'll take first dividend here. We know that it is 14% entire whatever the dividend received for 3 month period. So then foreign sales, the export part 14% we calculated here is 30,745. Then the manufacturing part also we calculated here 46,118. Then whatever the income tax at 24, and let's take about 28 first. The 28 entirely 9 month period, even there is a interest income investment category. Then we will take entire income because it is not fall under predominant rule. We take all the amount here, this entirely 200, and because we are taking this 750 also will fall under 28%. Then this amount 250, this 250, what you can do is you can take separately, because 3-month period standard rate is 24. Then this is the tax liability, tax payable, tax liability. What you can arrive based on the applicable different tax rates. So you can cross check the figures. Also the 309,450 we have taken here. Then you need to do this cross checking also whether we taken correctly. Then we find that all the income we have considered. Then this is the tax liability, income tax payable. Tax. This is the income tax liability. Then whatever the tax credits available, you can deduct based on the information given. Tax credit. Tax credits based on the information given. Tax credit, what you can deduct is basically based on the information provided. They have given under the information ESC. They have given. We'll take ESC first. Here, and then we'll take income tax, quarterly installment tax payment also here, quarterly installment income tax payments, income tax, and also there were withholding tax on interest and withholding tax on dividend. Are we going to claim these two? Are we going to claim withholding tax deducted on interest? Are we going to deduct withholding tax on interest? Are we? Yes. Are we? Then secondly, are we going to deduct withholding tax on dividend? I can't hear. I think you are mute.
We are going to deduct that withholding on interest income,
Right.
but as that dividend income is a final withholding payment for the first 9 months, so we are not going to deduct it.
Exactly, you are correct. Then we are going to only deduct withholding tax on interest, the 20 million. Then 20,000 basically. Then the interest part only we will deduct. As she said correctly, we are not going to deduct withholding tax paid on dividend because it is be treated as final. Then you can end up with, based on the information given, the balance income tax payable is basically 36 million. Balance income tax payable. Then can anyone tell me when this is due? Balance income tax payable for the year of assessment 1920, because we are now computing the calculation 1920 year when we need to pay this balance payment, because they paid quarterly they have paid 38 million. Then there is a balance payment when it is due. maybe a
30th September 2020.
exactly. The balance payment is due on 30th September. Then soon after you paid this balance 30th September, then also we are going to discuss income tax admin part also. Then the soon after you make the final payment, we call it as final payment. These days we are very busy on calculating final payment. So after deducting this final payment, then when you are going to submit the return, income tax return, final payment you made 30th September, then there is no any balance payable or refund due. Then the return for this year when it is due. You can comment on that also, that would be great. Balance when is the return, because we need to anyway soon after we calculate these things, finally what we have to do is we have to file income tax return by declaring these details. All the detail, what we have to do is we have to submit the return form. Return. So I refund you. There is no any balance payable. By declaring this, what you have to do is you have to file the return. Return is due on 30th November 2020. Then the return, then you have another 2 months after 30th September, October and November. Basically, we know that you are very busy these days when you are finding, because tax consultants or the tax preparers, maybe accountant or the tax consultant or the tax manager, the relevant company, they have already requested the audited financial statement in order to compute the balance tax payable, because everyone they are doing the quarterly payment based on the estimate. Then after the audit entries, there may be different amount you will get finally. Then if there is a balance payment, what you have to do is you have to make the balance payment is 30th September is the due date. Then you are rushing these days in order to finalize the audited accounts, finalize the financial statement. Then soon after you finalize, then what you can do is you have to calculate balance tax payable, and what soon after you calculate the balance tax payable you can pay, and then later you need to do the return filing. So if anyone, because there are some questions we are getting in practical, then if anyone couldn't make the payment, let's say anyone unable to make the payment on 30th September, what is the remedial action they can do? Then as per the tax law, the reason Inner Revenue Act, they facilitate another 14 days. Another 14 days. I know that then you will take mark of this and you will inform to relevant tax officer. You have another 14 days to make payment, but this is not the recommended, but law says you can anyway, penalty will not impose this another 14 days. Basically you have another 14 days as per the law to make the payment. Then the another 14 days is to make the payment. Then the 10% penalty will not arise on this. Penalty will not applicable, but interest 1.5% as per the act will accrue. Interest is there. The interest risk for that 14 days. So if you delay, you may have to pay interest because it is you cannot avoid, but the penalty, immediate 10% penalty you can avoid. And then the 30th September is the due date. I will explain when we are doing the income tax admin part. Soon after we finish non-resident taxation, we will move to the tax admin part, income tax admin part. Then we'll have a short break within 10 minutes and we'll start VAT on financial service. We'll have a short break and we'll start again 8:40 with the VAT on financial service calculation. Right. We'll start VAT on financial service. As you all aware, this is again important area because of recent tax changes. I will quickly summarize the things in the VAT on financial service with the whiteboard here. Let me share this one here. Right. And then I will explain VAT on financial service again with you. See the this timeline for the your year of assessment basically. year of assessment. Year of assessment for your exam, year of assessment would be 19. Assessment 19 and 20. So in that year of assessment, the VAT rate for VAT on financial service, it is same, you know, no any differences in VAT on financial service. Then VAT rate is 15%. But the interesting story was NBT removed. NBT removed with effective from when? With effective from when basically anyone when the NBT removed with effective from 1st December 2019 onward. 1st December 2019 onward, NBT removed. Then 4 months, then you don't have 4-month period, there are no any NBT, there's no any NBT rate applicable. Then only the 8-month applicable NBT. Then because when you are calculating VAT on financial service for the year, then what you do is when you are identify value addition attributable to financial service, whatever the value addition VAT on financial service and NBT on financial service, as we discussed, the P&L charge amount we need to add it back. Then separately you need to identify the VAT on financial service and NBT financial service separately, and you have to remove that part at the bottom of the calculation. Then when you are removing that part and also the adding back, then you need to keep it in mind, you need to remove VAT on financial service and NBT financial service, and also when you are calculating attributable to financial service, we normally did was 117 for this period, 8-month period. Whatever the value addition attributable to financial service, the value addition we divided by 117 multiplied by 17, because 117 means including 15% VAT rate and also the 2% NBT rate. Then this period, what we have to do is, because no more NBT is available, what we have to do is 115 into what is 15%, because no NBT. Then because only you have VAT portion, only you have VAT 15%. Therefore, then you need to keep in mind, in the case of year of assessment 1920, this is the scenario. Then if you are getting in the exam the same method, the year of assessment 1920, not the company where they are preparing accounts Jan to December, assuming that they are preparing accounts April to March, right? Then if it is April to March 2020, then this is the scenario where we discuss, right? Then again, the scenario where I will explain, then the stream December ending company. Again, December ending company also important, because the December ending company also important for you. You might get normal, most of the bank, they are preparing financial statement based on the calendar year basis, normally calendar year basis. So then in the case of calendar year, then you need to aware that basically because of the NBT change, let's say it is calendar year basis, they are starting January 1st, January 2019 to year ending 31st December 2019. Then keep it mind, then this is the year end, right? This is the year end. So then in order to prepare their veteran financial service, then in order to prepare their income tax return, basically what they have to do is they have to first of all take a approval from Commissioner General. Then only they can prepare account based on the financial year. So assuming that they are taking approval for in order to prepare the financial statement January to December, and in order to comply the VAT and VAT laws, veteran financial service, compute the veteran financial service liability and also the income tax liability based on the calendar year, then they need to consider in this year of assessment 19-20, when they are preparing veteran financial service, they are required to check. They are required to check again the NBT change, because you know that this period, the 11 month, they have VAT and NBT both, because from with effective from 1st December 2019, no more NBT. Therefore, you may come across where the first 1 month only, 1 month, they have only VAT. Then the VAT 15%. Then in that case, they need to deduct. They need to calculate value addition by dividing 115 multiplied by 15. And in this case, because they have VAT 15% and also they have NBT 2%, then altogether they can calculate by dividing 117 into 17. So this is the timeline for December company, as when we take into consideration December company, then you need to aware this timeline, right? Then you need to keep it your mind which year of assessment in the which financial year this company falls. If it is December, you need to keep in mind and take account, you need to compute the veteran financial service liability based on the NBT application only for respective months. Therefore, that is why this short notice mind map is given. I will share this mind map also with you. Then again, I will share what we discussed in order to recap your memory, veteran financial service. I will share the veteran financial service, the calculation part also, because I will quickly run through the calculation part in order just to recap your memory. In that, I'm sharing the screen with you now. Let me share the screen. Veteran financial service. Here, right. Here, this is the veteran financial service. We discussed the summary of the calculation part. Computation of value addition up to 30th November 2019 before removing NBT part. Then you can see what we did was normal calculation is we need to take PBT, and then whatever the VAT and NBT on financial service charge to PNL we need to add it, and depreciation charge to PNL we need to add it, and the emolument we need to add it, and then economic depreciation we can remove. Economic depreciation, you know that what is the economic depreciation means. Basically, not the capital allowance rate. We need to apply economic depreciation rate as per the Gazette. These are the economic depreciation rates we explain in that day. Then you can go through with the TUT and see the economic depreciation and how to calculate the economic depreciation. So then in that case, then you will finally end up with total value addition prior to tax. Then what you need to do is then value addition attributable financial service also you are required to compute. Then the percentage of financial service, let's say they have 100 million turnover, out of 100, 90%, if it is financial service revenue, then you need to multiply it by 90. Then the percentage also you need to calculate. Then the because you need to apportion the total value addition prior to tax based on the turnover basis. Then you will end up with this, and then you need to remove VAT and MBT payable on financial service actual payable, because whatever the provisions they are charged to PNL, we need to add it here, and actual you can deduct by dividing the value addition into 117 and multiplied by 70. So then you will end up with value addition attributable to financial service, and then you can calculate VAT on financial service, and here NBT on financial service is 2%. Then in the case of December, from December 1st onward, the calculation is the same method, but here without NBT. Without NBT, only you can see 115 divided by 150 multiplied by 50. Then there is no any NBT. Then you need to calculate the NBT payable based on this method. So then, first of all, you need to identify which year that company falls. If it is bank, most probably based on the given in the question, you need to identify if it is December company. Then you need to identify whatever the mind map I discussed in the whiteboard. So here I'm just sharing the whiteboard again to identify these periods. Because in the question is also given for the December, because most of the banks, they are fall under December calendar year basis, they are preparing financial statement. So then most probably the year is December, because most of the financial statement of the banks, they are preparing December ending basis. So then moving to the calculation again, here we'll go to the requirement first. And here this is again, you have basically homework also. I will do only the first part. Assess VAT liability on financial services for the year ending 31st December 2019 as per the provision of VAT Act, assuming NBT is not abolished with effective. It is not abolished. Then this is not the case for you. This is maybe some other cases you can calculate without abolishing NBT. Then it is easy for you. If it is not NBT abolished, you can entirely calculate easily VAT on financial service. Because now we are going to the difficult part for your calculation, because recent changes also in this curriculum under the ACCC, the your tax advanced taxation. In this curriculum, we will take into the consideration all the recent changes. Therefore, you need to aware those recent changes. Then we are not going to do the first part with the recent changes, assuming NBT is abolished with effective from 1st of December 2019. Assuming that we'll do the calculation. No NBT with effective from December 1st, 2019. We'll do the calculation VAT liability on financial service. So we'll move to the calculation sections, the detail given in this section. The Quick Finance PLC is a finance company listed in Colombo Stock Exchange according to the draft financial statement prepared for the year ended December 2019. Here you are aware you need to highlight the year ending 31st December 2019. It is very, very important because without having that year understanding, you can't do the calculation. So then you need to aware that year and we'll do the rest of the reading and do the calculation. So then the QP, Quick Finance, has earned profit before tax amounting. Here the profit before tax also they are given. Then we know that 54 million is the profit before tax. Then you are provided with the following financial information for the year ended December 31st, 2019. These are the information they have given. Whatever all the income sources they have given, the revenue and other operating income as follows. So the revenue, we know that interest income, easy payment, hire purchase, leases, treasury bill, deposit, loans, overdue interest. Under interest income, if it is bank or finance company, definitely we know that this interest income, definitely we can consider it as a financial service transactions. So in the case of interest on loans, here the loan also they are providing sub breakup, note 1. Note 1, in the case of interest income on loans, they are providing different loan facilities: mortgage loan, personal loans, personal related party loans, and the term loans, vehicle loans. Then whatever the income, again here also all the income relating to are relating to finance company. Then they have provided other operating income also. Under other operating income, the commission income, gain from land sales, documentation charges, fixed asset disposal income, rent income, dividend income. They have other operating income too. Then interest income on lease and overdue interest include 4.1 million and 425,000 respectively. They have interest income on lease and overdue interest. It is included 4.1 million and 425,000 respectively, earned from lease facilities provided 25th October 2014 prior to 25th October 2015. So keep it in mind, then prior to 25th October 2014, then any interest for that particular period, the before 25th October 2014, those are liable to normal VAT. With effective from 25th October 2014, all other leases they categorize as an exemption from normal VAT. They transit to the financial service. Then they are required to calculate. They have to consider that any interest income after that financial service. Then before that, if there is a before, then this examiner has given this amount, this before. Then you need to consider this amount before the VAT on financial service liable period. Then what you have to do is you need to treat it as this normal VAT liable period. So therefore you need to exclude, keep in mind this one. Then some expenses incurred and recorded as follows. Then the expenses they are providing EPF, ETF, and depreciation, gratuity, staff salaries, staff allowances, staff incentive, staff welfare, advertising, director fee, staff medical and maximum insurance, the provision for doubtful debt, entertainment, donation, MDT on financial service, DRL on financial service, and VAT on financial service. Then these are the expenses. Then economic depreciation allowance claim for the year ended 31st December 2018 was 2.8 million. None of the asset fully depreciated as at the end of 31st December 2019, and none of the asset was disposed during the year 1920. Then it makes sense that the economic depreciation for this year also remain as it is. So then the following assets were purchased during the year, then you have to do the economic depreciation calculation. Then the for the year of assessment, number of days also given. It is also a hint for you to calculate the separate two period. And when you are calculating the value addition attributable to financial service. We'll do the calculation part. Move into the calculation. Let me share the screen first with you. I think you can see the screen. Right, I just pre-prepared the format for the in order to reduce the time. First of all, I will take one by one in order to, because we need to identify the turnover first when you are doing the calculation. Then we need to first of all identify the period Jan to December 2019. Then the turnover we have to identify two separately. What are the financial service related turnover and non-financial related turnover. So we'll identify with the question. I will take the figures from the question to here. Then the interest income, they have given interest income. Interest income, I will make it here for you. See this interest income, they are given interest income also 223,400 is the interest income. All right, then this is, I will make times right, the interest income they have given, and also the interest income total amount, and also they having other operating income. They have other operating income too. In other operating income, we need to identify separately what are the other operating income liable for VAT on financial service and not VAT on financial service. This is VAT on financial service related incomes. Then non-financial service. I will separate into two, non-financial service. So these two segregation is required when you are doing the VAT on financial service. Then I will end up with total turnover here. Then total turnover you can see. Then the interest income we can categorize entirely is related to financial service, or any doubt. Then the other operating income, we need to carefully look at the other operating income one by one, whether those are fall under normal VAT or the VAT on financial service. We'll take one by one operating income. Then request you to comment these income, whether those are fall under financial service or not. Then you can comment whether those incomes falls under financial service or not. Commission income. Likewise, I think everyone can see the screen. Hope you all can see the screen. Can anyone tell me whether the Excel which I shared with you is visible? Hope you can see the screen.
Yeah, we can see, sir.
Okay, good. We'll see. This is basically the commission income, right? Is it liable for normal VAT or VAT on financial service? Is it VAT liable, normal VAT or the VAT on financial service? We can see because there is commission income, then there maybe you can put even assumption. You can make even assumption saying that assumption saying that it is financial service, but in the without having assumption, because it is we are assuming that it is basically this 100 not relating to financial activity, then we will categorize as a non-financial service. Then anyone can argue, because that tax perspective in the exam perspective, even if you can assume that this commission is relating to financial service, leasing facility or something like that. If it is, if you can assume that, then that one can be also considered as a financial service. So the gain from land sales, then the no worries, then 11,000 definitely non-financial service because it is not a financial activity. So then the documentation charges also, what we can do is documentation charges 5,400. Again, we can categorize as a non-financial service. Then some companies still they are in practice, they are considering as a financial service because these documentation basically they are related to lease document, agreement. They when they are signing agreement, there are some documentations requirement. Then they can categorize that one. But in this perspective, then because the no information given, then we can assume as a non-financial service. Then fixed asset disposal income. Again, what we can do is basically it is we can categorize as a fixed asset non-financial service. Then it is not fall under financial service category. Then the rent income also we can categorize as a non-financial service. Then the dividend income, whether it is coming under financial service or non-financial service, dividend income. Dividend income also in a finance company perspective. In a finance company perspective, dividend company, we can categorize, we are required to categorize the dividend income also as a financial service, because that dividend as per the VAT Act, if they are doing the business of financial service, then the dividend income also should be treated as a financial service. Then these 30,000 will fall under non-financial service. Then these will fall under financial service. But then again, there is a small thing we need to adjust under interest income. we went through when we are reading the question. When we are reading the question, we came across lease interest and lease interest, interest income on lease and overdue interest include income which are relating to before VAT on financial service period that are normal VAT liable. Then that part also we need to remove from this. Then then what we can do is all together 4,525. 4,000 altogether, let's say. And for altogether, we need to we can categorize as a non-financial service. Maybe this, but here the financial service is relating to only by removing this part. What we can do is from entire financial service, you need to remove this amount, non-financial service amount. Then end up with your balance is 223,400 is the amount as per the calculation. Let me share the PDF also. This is 223,400 and in that it is include lease and overdue interest. It is 401 and 425, 4,100 and 425. We need to remove that part from this total amount. Then these are the financial service, but it includes overdue interest under this, and this include 4,100, and here they include, we need to reduce 4,100, and also from here we need to reduce 425. Then these two we need to remove from calculation. Then again there is a small adjustment on. Let me share the Excel screen again. Then the disposal here, fixed asset disposal income. Basically, we need to take the gross amount because the other operating income they may have accounted this one, the amount in the profit, because this is maybe the profit they have given. What we have to do is we need to identify the gain from profit, the disposal proceed, whatever the disposal profit, we need to calculate and identify that when we are doing the, when we are taking into consideration the sale proceed, basically. So let me do the adjustment first. Right. Right. I am sharing the screen for dividend. One section came for dividend. Wait, I am sharing the screen. The VAT on financial service slide. Right here, whatever the income sources, basically we are excluding exempt supplies, zero rate supply, taxable supply, and the normal, because we remove whatever the as examiner given the 4,100 and 425, which are liable to normal prior period lease interest. So then we need to remove those things because those are exclusion from taxable value addition. Then this is one section. Then again another section came. Here dividend income. Dividend income in interest income, dividend, and again income from dealing with shares. Also, we need to consider. Here. Here, dividend income. What we need to do is in the again what Act specifically says above exclusion non-taxable. As non-taxable mentioned, 4 to 8 shall not apply. Shall not apply following person. As we discuss, the 4 to 8 is basically these things. 4 to 8. By highlighting these 4 to 8 is not applicable for finance company. Then, if it is finance company or a bank, if they are doing entire licensed commercial bank, finance company, licensed specialized bank, then what we have to do is we need to identify with this finance company. Then dividend income also should treat it as a liable supply for financial service. That's it. Then we'll move to the section again. Right. Then here I'm sharing the PDF section again. Then you can see in the figures given the value addition, excess VAT liability on financial service year ended. Then what we did was previously, first of all, we need to identify financial service amount. Basically, what we did was by taking this amount, I'm sharing again. I know to identify interest income we took here by removing interest, whatever the normal VAT liable portion we removed, and again we took all the income, other income, the operating income we removed, and then we are now we can calculate whatever the income which are related to financial service, which are not related to financial service. Then we will total all together these income sources will fall under financial service. I will take this up. Then this income will fall under non-financial service. Then what we can do is we need to identify this amount by dividing total income, the percentage. Percentage is 86.48. Then the next is you can do you need to identify normal VAT, non-financial service. Then percentage wise also you identify. Then what we are going to do is the turnover related to financial service, we'll take it from here. Turnover related to financial service and non-financial service, and the percentage also we are taking from here and here. Then the total turnover should be tally with this amount. The amount is 255,400. This is the amount. Then you know that this is, we are assuming that as I said, the sale proceed. This is the total amount. We know that the percentage also given, taken, we calculated. And then what we are going to do is we have to take the profit before tax, PBT. Based on the question, I will move to the question. The sections they have given the profit before tax 54,350 is the profit before tax. Profit before tax 54 million. I'm calculating in 1000. I'll make it here as 1000. In the 1000. Then 54 million. Then what we have to do is whatever the amount charged to P&L, we need to take. Then I will share quickly the PDF document because whatever the amount charged to P&L, you need to add it. Here they have given NBT on financial service and VAT on financial service separately. So then we know that NBT on financial service this much and VAT on financial service also this much. Then there is a DRL portion also. Are we going to add DRL? Anyone? Are we going to add DRL also to the calculation?
No, sir.
Yeah, exactly. We are not going to add DRL because some students they feel like the DRL on financial service debt repayment levy basically. Debt repayment levy no more there. Then it is also abolished with effective from 1st January 2020. Then the DRL as per the VAT law, Gazette notification, you are not required to add. Then keep in mind, examiner might give the DRL portion also. Then when you are doing the calculation, don't take DRL portion. So therefore, whatever the amount on NBT on financial service, you can take it from the calculation section, NBT on financial service, and the again the VAT on financial service part here. Also you can edit. Then the DRL part, don't take that DRL part because it is normally we did when we are doing the debt repayment levy calculation. Here the examiner because it is already abolished, then we are not going to take DRL calculations. So then the VAT on financial service, if it is given even, you are not required to add the DRL on financial service. Then what we have to do is emoluments. Emoluments, all the emoluments we need to add it, and in this calculation, then I will take the emoluments detail from the calculation. Then these are the details. I will let me. Right, emolument, are we going to take all the emoluments provided? Normally bank and financial companies, normally what they are doing is under personal costs. Under personal cost, they will categorize all the emoluments. All the emoluments. Then what you need to do is, you are not going to take all the emoluments they categorize under personal cost. What you need to do is, let me share this again, the calculation here. You are not required to take all the emoluments here. You can take the relevant amounts only. Here I just copy paste all the detail. Then I will check with you in order to capture whatever as per the Gazette notification, what are the items we can take for VAT on financial service with regards to emoluments. basically. Then emoluments payable, you can comment. Then these are the items we are taking. EPF, ETF, anyway we are going to take. Depreciation is not relevant for here now. Then the gratuity we are taking. Staff salary we are taking. Staff allowance we need to take. Staff incentive we need to take. Are we going to take staff welfare? Welfare is not an employment benefit. Therefore, we are not going to take that part. Not an employment benefit. Right? It is not an employment benefit. So then advertising is not related to here, not relevant. Here not relevant for this one. It's not applicable. Here also the same. And then director fee we need to take. Staff medical and accident insurance. Then if it is providing as a allowance, employment benefit, then if it is allowance, we will consider as allowance, assuming that if it is not so clear at the exam, you can make an assumption assuming that it is allowance or the benefit given as a, then you can consider as a employment benefit. Then I'm assuming here it is also benefit to given employee. Then provision for doubtful debt, it is not relevant to here. Entertainment, not relevant to here. Donation, the VAT on FS, those things we all the other things, because we are now calculating the emoluments payable is how much. Those are the amounts. 26. Yeah, it is correct. 26. This amount, what we need to do is emolument payable. As emolument payable, we need to add it to the. So I added emoluments. Then what we need to do is again book depreciation. Also we are going to add here. I just put it book depreciation. That amount also we need to add it. Then what you can do is economic depreciation calculation. Economic depreciation, you need to do the calculation economic depreciation again, like we did here in the side. Then the economic depreciation, previous assets. Anyway, the examiner has given 2.8 is the amount for previous assets. Then the whatever the new additions we will take from the calculation, whatever the new additions the examiner giving. Then separately we need to take into the consideration this new addition also. Then these are the new additions. Then under you can see previous asset, we don't worry about the previous asset. Examiner directly they have given the economic depreciation amount. Economic depreciation on previous assets in the section itself. Then the asset also in the during the year additions, during the addition, new addition, it will economic depreciation on new additions. What we can do is new additions, we need to identify the relevant economic depreciation rates. As I shared previously, the rate for your reference, the rates, the capital allowance rates are not applicable here. You need to take the rates as per the computation. So then the rates applicable for economic depreciation office and furniture is basically office and furniture. What is the rate? The rate is furniture 12.5%. 12.5%. Then office equipment also. Then the software, computer software, what is the rate for as per the Gazette? 25%. Then what you can do is you need to calculate the economic depreciation accordingly. Then total economic depreciation you can end up with here altogether 3,570 is the total economic depreciation. So this amount you can take as economic depreciation. When you are doing monthly calculation, keep in mind you have to divide it by 12. Right? Here we are not going to calculate monthly. This is annual calculation. Here, then what we need to do is we will add total economic depreciation as calculated. Then economic depreciation also we calculated. Then what we are going to do is total, and then we need to add up these two and deduct in this. What we can do is on this amount we need to add this and remove this, and then you will end up with this amount, and then what we call it as this amount as value addition prior to tax. We didn't deduct tax amount because tax amount in the sense we added P&L provisions, then we need to deduct tax. Then before removing tax, we need to identify the value addition prior to tax attributable to financial service. Attributable to financial service relevant percentage is, we know now, 86%. 86%. So then the 86% we are taking from there, then we need to multiply the value addition prior to tax into 86.48. Then we will end up with value addition prior to tax attributable to financial service. Then you know that this figure. Then this is the complicated part. Again, in the practice, you need to aware. This is end of the session. This is very important part. Then Jan to November period, you know that we need to apportion this value addition attributable to prior to tax attributable to financial service. Then prior to tax means this is prior to tax amount, because we are going to remove the tax amount here. Then the important part we are going to do now. Then we are going to remove the tax amount. Then we need to take the value addition prior to tax attributable to financial service based on the date, number of days. Then we will take this amount divided by 365 and multiplied by number of days for 11 months. Number of days for 11 months. Then you will end up with this amount, and then again what you need to do is, this is the value addition attributable to prior to tax for 11-month period. Then this is basically for balance last month, because here no NBT. Here, as I explained, no NBT, right? Here NBT is there. Therefore, then again you will end up with total is equal to above. This is anyway value, right? Then what you need to do is here. What you need to do is you can here the 11 month you need to divide it by 117 multiplied by 17, because this period NBT and VAT both are there, right? Here NBT and VAT both are there. I will mention VAT and NBT both are there. Therefore, you need to deduct this amount, this amount as a deduction, because we calculate prior to tax. After this deduction, we call it as what? After the tax. The normal value addition we will end up with. Here also, what we are going to do is we need to deduct this one by 115 and multiply it by 15. Then you are removing the only for the VAT portion. Here VAT portion, here all VAT and NBT both. Then you will end up with value addition attributable to supply of financial service. Here value addition attributable to financial service. Then what you will do is this amount you need to multiply it by 15%. Then you will end up with this amount. 10 million is the amount. Then what you have to do is any payment you made, let's say you made 10 million monthly, because VAT on financial service you are required to pay monthly. Then if they have paid monthly 10 million, then balance payable is required to make the payment. Normally, in the case of annual adjustment, when it is the due date, the case of December company, annual adjustment, I explained in the class, annual adjustment, then annual adjustment is when is the due annual adjustment, VATFS annual adjustment for December company, VATFS annual, can anyone tell? For December company, annual adjustment when is due? When was due? Then March ending company. March ending company, you have to anyway know this one. March ending company. December ending company, it was annual adjustment was due, because these are very important things. The December ending company, it was due 30th June 2020 was due. Then the March ending company, now we are struggling again, it is due on 30th September 2020. Then we are finalizing these days, March ending finance companies pattern, annual adjustment, and also the balance payment, if there is any, then this amount also need to pay 113 million, also the on or before that date. And March ending company, then the 30 September. Right. Hope you understood the VAT on financial service calculation relating to December ending company. Then the same calculation you can do for the March ending company and see the difference. And you can discuss any answers with me if you have any issues relating to this. Hope you all understood. We will wind up for today. We will meet next session together with non-resident payment. Thank you for